Also want to alert you to the fact that nothing buoys the markets like news that there's a vaccine or potential treatment or treatments for the virus. Second to that would probably be more stimulus. Now, I know normally these guys worry about spending too much at the corner wall and broad, but since no one else is really worried about it, they're hoping to see more. The question is, what would that stimulus look like? What would be the makeup of it? How much would it be? And how much would it cost? The fact of the matter is that we ran an $864 billion deficit. That's how much more we spent than we took in 1 month, the month of June. We've never seen anything like that. We're looking at likely a $3 trillion deficit when all is said and done on the year, and that might be optimistic thinking. Ed Mills joins us right now, the Raymond James policy analyst. Edward Stringham, the American Institute for Economic Research president. Ed Mills, let me begin with you. It seems like gone are the days where the street worried about deficits and debt, maybe thinking, spend this money now, do what you have to do now, address paying for it later. What do you think?
Yeah, Neil, I think you're absolutely right. And it's not only the street who doesn't care about that right now, it's Congress, it's the Fed. We are in the middle of the largest ever fiscal and monetary experiment in the history of the world. And any economist that is looking at the current situation, especially with the resurgence of the virus, says continued fiscal support is necessary. We believe at the end of the month, Congress will deliver on that, but it's going to be a nasty fight, especially as we get up and close to the end of the month when the extra $600 per week unemployment benefits would expire. That would be a huge fiscal cliff for millions of Americans that the market is really hoping to avoid.
You know, Edward Stringham, on that stimulus and the more generous federal unemployment benefits that end, as Ed just stated, at the end of this month, they're trying to come up with something that will incentivize Americans to go back. Congressman Brady of Texas among those, saying maybe a one-time $1,200 payment to entice them back. These are expensive things to do. What do you think?
Yeah, certainly. There have been a lot of experimental policies, and unfortunately, I think many poorly thought through ideas. We see the extra payment for unemployed people through the CARES Act meant that most of these people, high percentage of people, were actually getting more money to not work than to work. That created tremendous disruptions for the businesses who actually wanted to get these people back on the payroll, get them off unemployment insurance. So I'm actually going to disagree with our friend Ed here and say that there's certain economists, including me, who said these are just tremendously costly and there's lots of unintended consequences. There's this idea called the broken window fallacy, and the idea is that the government spends more money, it's going to increase GDP. But Henry Hazlitt, other economists pointed out, you're actually taking money from the private sector. So that's ultimately coming out of taxpayers' pocketbooks and corporations' coffers.
You know, Ed Mills, the other argument is how you pay for this down the road. There are a number of millionaires and billionaires who've signed this sort of joint letter, Abigail Disney among them, the niece of the founder of Disney, saying, tax me more, tax us more, get a wealth tax going, an asset tax, whatever you want to call it, to pay for this, and some of the virus relief and other things the country needs. Now, I suspect that even if you tax those guys at 100%, it's not going to cover the cost of all of this, but your thoughts?
Yeah, no, I think you're right, Neil. What you see is that the amount of money we're spending versus what you would need to raise in taxes, they're really mismatched, especially for how much we're spending in such a short period of time. But I know that we're going to be pivoting towards the election in the markets here very shortly. In November, if you do see an election where Joe Biden wins the presidency and there is a Democratic sweep, I think the market will be much more focused on what tax policy looks like in 2021 and beyond. And Joe Biden has been very clear that if he wins election, that there's going to be a change to the current tax policy and taxes will be going up.
You know, Edward, on that quick last note, if you don't mind, this notion that the Federal Reserve will always be there and the Federal Reserve will be the sort of backstop for what could be a huge selling wave or frustration, that it has played a key role in sort of righting the ship, if that's how you want to put it, and it will continue to, regardless of who wins the White House. What do you think?
Well, they've been trying to support markets. Getting involved with corporate bond markets has been very interesting. But at the end of the day, they do have limited powers, and they're going to be the first ones to admit that. They can't just press this magic button and solve all of our economic problems whenever they want. And eventually there can be upward pressure on inflation. So one thing that they've been doing the last decade is paying interest on excess reserves, paying banks not to lend out money. And that actually, even from the Federal Reserve's perspective, has been limiting the ability for them to get money into the economy. That's also, I would argue, putting downward pressure on inflation. So they're in a new atmosphere that it's uncharted waters, and they have limited ability.
Gentlemen, I want to thank you both. Appreciated your insight right now. So much depends on the kind of stimulus we see.